Since the dawn of organized exchange, a fundamental error embedded in the human psyche that governs this exchange has existed, and it is not merely greed. We're talking about the philosophy of greed. But it is not about the desire to gain more. It is about the internal necessity to validate what you already possess. Every open position in the market is not just a trade, it is an act of ownership that we begin to defend with every psychological weapon available to our consciousness. This is the core of our discussion, and it explains why the crowd, as a single organism, always runs synchronously toward the edge of the cliff, failing to notice the drop. We will examine this process through the lens of Adam Smith, who, long before charts and candles appeared, described the internal mechanism that compels us to betray our own interests for the sake of a dubious social or self-truth. It must be understood that trading is a perfect, cruel proving ground for studying human nature. The crux of the problem lies in the transformation of an abstract decision into a concrete object, your position. The moment you press the button, that position ceases to be just numbers. It becomes an extension of your ego, your intellectual correctness, your property. It is this correctness that demands external confirmation, and it is this need that destroys discipline. The market knows no emotions, but it perfectly reflects our internal conflicts, converting our psychological gaps into financial losses. When the market moves against our position, we feel not only financial pain, but also a blow to our self-esteem, which is the strongest motivator for irrational revenge. Therefore, we do not just hold a losing trade, we relentlessly seek out news or comments that will confirm our initial, perhaps flawed, thesis.
If Smith taught us that society functions because of people's desires, the market confirms that the desires of the crowd function because of the psychology of ownership. We enter a trade believing in a certain narrative, but then, instead of managing risk, we manage our attachment to that narrative. As the price moves in the opposite direction, we don't ask, "Was my analysis wrong?" We ask, "Why doesn't the world see my correctness?" This creates a crowd that stubbornly ignores external signals because the internal need for validation of the position outweighs cold calculation. The successful trader is the one who has learned to separate the self from the ownership of the trade. Everyone who gathers in the market seeks not just profit, but above all social affirmation, if only from themselves, that they are smarter, faster, and see the big picture better. This is why when you see an asset soaring and everyone in the chats is celebrating, you feel a physical discomfort. This feeling is not greed for money, it is greed for belonging to success and intellectual superiority. This acute need to join the game late is a classic example of how individual greed for psychological validation creates a collective irrational stampede. This is a fundamental weakness that we must transform into a structural advantage.
Our goal is to apply philosophical tools to create pragmatic armor against this innate tendency. We will not talk about abstract emotions. We will talk about the specific, measurable actions that the market demands of us. Smith's philosophy gives us the vocabulary to name the enemy that resides within us, and its main weapon is the desire to feel sympathy from the market and other participants. By separating the self from the position, we can move from defending our ego to managing capital. Adam Smith's The Theory of Moral Sentiments, the code to human behavior, not just economics, but the fundamental psychology that governs us. Discover how the impartial spectator, your internal rational judge, and sympathy, the collective need for alignment, shape markets and decisions. This is an indispensable guide for traders, leaders, and anyone striving for true discipline. Understand how the moral quality of your motive outweighs the financial outcome. The link to the book is right below this video. Order now to control your world, not just react to it. The central lever in this philosophy is the concept of sympathy, which Smith describes not as pity, but as our capacity to feel the same as another, a desire for the concordance of feelings. In the market, this translates into an overwhelming need to feel the alignment of our decisions with the general movement, or more importantly, with our expected outcome. When we enter a position, we expect the price to grant us this sympathy by moving in our favor. If the price falls, we experience a psychological rupture,
and this rupture stimulates not the rational cutting of losses, but the emotional doubling down to restore internal harmony. This psychological pull toward alignment is the fuel for the perfect market pattern, climax and reversal. When the price makes a strong move, everyone involved feels powerful sympathy from their peers and the market. They feel like part of the correct winning crowd, and this collective harmony pushes the price higher, far beyond rational valuation. All feelings align, and no one wants to be the one to disrupt this harmony by selling too early. Trading formula: sympathy equals irrational acceleration after breaking a key psychological level.
It is the desire for collective validation that leads the crowd to the abyss, because no one can or wants to stop until sympathy changes to its opposite, which is panic. Panic is nothing more than an abrupt shift in alignment. Suddenly, everyone feels the same thing, fear, and the desire to be a single organism compels everyone to sell simultaneously. The market always runs to the abyss because the abyss is the point of maximum psychological alignment, whether euphoria or terror. This is not intelligent design, it is a pure psychological law of the masses. Consider a typical micro scene. You opened a short on a resilient asset, anticipating a correction after a long rally. Suddenly, you see news or an influential tweet that contradicts your trade, and the price makes a small upward move. Your first instinctive reaction is to reach for the close button without a signal, just to avoid social condemnation, even if it's internal, for standing against the general sentiment. This internal conflict is a battle between your cold plan and the need for sympathy from the outside world, which supposedly confirms that being long is currently correct.
The wise trader understands that the market does not offer sympathy, it only offers opportunity. Our task is to learn to ignore this internal pressure for alignment. We must focus not on what others feel or how our position should feel, but on what our predetermined conditions indicate. Only by detaching ourselves from this innate need for validation can we act against the crowd and preserve our capital integrity.
To counter the impulse of sympathy, we need an internal arbiter. Smith called it the impartial spectator. The spectator is not merely rationality, it is an idealized internal judge who can objectively assess your motives and actions, ignoring the consequences. In the context of trading, the impartial spectator is your discipline, based on a clear dichotomy of control. It is the only one who can provide true confirmation, and this confirmation pertains exclusively to the process, not the outcome. The impartial spectator always sees two separate worlds that must never intersect at the moment of decision-making. The trader's control is limited to only three variables: the plan, the risk, and the execution. Everything else belongs to the world that is uncontrollable: price, news, the crowd, and most importantly, the final financial result of the trade. The true work of a trader is to bring their execution as close as possible to the demands of the plan, regardless of external fluctuations.
When you see a 3% candle and your heart starts racing, the internal spectator must ask, does this candle meet my exit conditions? If the stop loss has not yet been hit, the spectator demands adherence to the plan. If you decide to close the position because it seems like things are bad, you are succumbing to external sympathy, collective fear, not the internal moral quality of execution. Trading formula: impartial spectator equals a predetermined stop loss, executed without any additional emotional or informational deliberation. Thus, the function of the impartial spectator is not in forecasting, but in the absolute defense of the integrity of your process. This is the only force that can withstand the pressure of validation and the crowd. The internal judge delivers a verdict not on how much you earned, but on whether your entry and exit were perfectly synchronized with the rules you set for yourself in a state of cold rationality.
The impartial spectator should not be passive. It is an active calibration tool for entry. Its work begins even before you press the button, demanding a clear moral quality of your motive. Smith defined moral quality as the assessment of motives, not consequences. If your motive is to catch the train because everyone else made money, the moral quality of the trade is zero, even if it yields a profit. The successful trader understands that a rule-breaking trade is always a losing trade, regardless of its financial outcome. The moral quality of your action in the market is measured simply:
Does this trade have a clear, written-down, objective entry signal, or is it a reaction to external noise or an internal desire to act? If the motive is revenge on the market for yesterday's loss, the spectator must veto it. If the motive is an attempt to quickly recover losses, moral quality is absent, and you are essentially betting against yourself.
The practical application of the impartial spectator lies in creating a screen of protection around your stop-loss. You must be prepared to accept a loss as an inevitable, neutral result of rule adherence, not as a personal defeat. When you perceive the loss as part of the system and not part of the self, you maintain the moral quality of the process. This allows you to quickly move to the next trade, unburdened by psychological debt. Micro scene of revenge. You closed a position with a large loss and see the price making a small pullback. You open a trade in the other direction because you want to get back at the market for taking your money. This is an act of psychological aggression, not calculation. The impartial spectator must intervene here and say, your motive is emotional buyback. Stop. This is not in the plan.
The impartial spectator must also control the desire for apophenia, seeing patterns where none exist, solely to justify your position. When the market moves against you, you begin searching for Fibonacci, candlestick patterns, or astrological coincidences that will confirm you are right. This self-deception is a direct violation of moral quality, as you are adjusting reality to fit your desire to own the position. Trading formula. Moral quality equals an objective entry signal that would exist even if you hadn't seen the chart. We often confuse the moral quality of the process with the validation of the outcome, and this is the central trigger that pushes the price too far. When a trader sees their position grow, they receive validation from the market, and this validation feels so pleasant that they begin to ignore fixation signals. They do not want their feeling of sympathy with the price rise to stop. This creates the illusion that the market will always align with their desire. This psychological phenomenon explains why at the peak of a boom, people buy an asset relying on a so-called ideal system. In Smith's conception, the ideal system is a perfect, though illusory, order that we try to impose on chaotic reality. In the market, this is the belief that this asset cannot fall, or this pattern is 100% going to work, ignoring history and risk. The ideal system is an attempt to replace risk with perfect certainty, and this leads to the abandonment of stop losses. People believe they have cracked the code, and therefore they deserve continuous profit. Trading formula. Ideal system equals the denial of risk after a series of successful trades. When the spectator is absent, the trader falls under the influence of the ideal system, and their position turns into an idol. They begin to defend it, investing more and more money, not because it is rational, but because they cannot allow their ideal system to collapse. We must constantly remember that the market operates on absolute amorality regarding our financial and psychological expectations. The market does not assess our labor or intellect, it only reacts to liquidity. Thus, the only way to survive is to replace the pursuit of sympathy and the ideal system with unwavering fidelity to strict, unemotional rules. The driving force of the chaos created by the collective greed for validation is the invisible hand, but in the market it operates not as a moral compass, but as a mechanism for destroying excessive psychological commitments. It is not a mystical force, but the simple functioning of liquidity created by the difference between desire and reality. When the crowd feels maximum sympathy, buying at the top, the invisible hand simply creates the opposing force, liquidation. The invisible hand in the trading market manifests in the typical dynamics of liquidity around key levels. When the price breaks strong resistance, most investors feel euphoria and enter the trade, receiving instant psychological sympathy. This creates the perfect convergence for those who had a plan to sell, an excess of demand. Thus, the invisible hand uses collective greed for validation to create ideal conditions for a reversal. This dynamic explains why fake-outs occur so often, which are a pure manifestation of the invisible hand. The crowd, seeking sympathy and confirmation, enters on breakouts, and these entries create the liquidity needed by large players to fix positions. This is not a conscious act of destroying small traders. It is simply the inevitable consequence of the crowd using price as a source of self-affirmation. Our task is to transform the invisible hand, which pushes the crowd to the abyss, into a tool for strategic entry and exit. We must seek out places where the crowd's psychological sympathy will be strongest, as that is where the densest liquidation zones are located. We buy not when we feel sympathy for the price, but when we see the majority feeling maximum alignment in the opposite direction. Trading formula. Invisible hand equals a cluster of liquidations forming immediately after an irrational, swift breakout of a key level. This cynical yet realistic view demands that we replace the belief in the ideal system with the cold calculation of risk created by the crowd's excessive psychological ownership. Only in this way can we leverage the power that destroys others. The only defense against the psychological mechanism of sympathy and the greed for validation is the absolute mechanization of the process. We must create an ideal system, not for the market, but for ourselves. A system that demands the intervention of the impartial spectator at every stage. This system must be simpler than our emotions so that we can adhere to it even in moments of greatest panic or euphoria. We need a physical, mental, and operational checklist to separate the process from the result. The first element of defense is the predetermination of the moral quality of the trade. The defense against validation checklist should look like this. Before entry, is there a clear, objective signal, not just a feeling? Has the maximum stop loss been set in monetary terms? Has the position size been determined according to the risk per deposit? Does a clear validation exist, e.g. closing above or below the level plus a retest or volume confirmation? The second element is protection during trade execution, when the crowd's sympathy is strongest. During the trade, do not read chats or social media that might undermine the moral quality of your position. Do not move the stop loss to give the market a little more time. This is a direct betrayal of the impartial spectator. Maintain a neutral stance toward the financial result, focusing only on holding or exiting according to the plan. Third, the importance of kairos, the right moment, in trading. Unlike chronological time, kairos is not time, but a psychological opportunity. Kairos occurs when the crowd's sympathy reaches its peak and the price begins to reverse. Trading formula. Kairos equals the speed with which the price reverts back under or over a key level after a false breakout. Your trading journal is the place where the impartial spectator can perform its work retrospectively, assessing not profit, but the process. If you made money but violated the rules, the spectator must declare it a losing trade in terms of moral quality. If you lost money but strictly adhered to the plan, it was a successful trade. The philosophy of greed teaches us that the run to the abyss begins the moment we start seeking external confirmation of our internal correctness. We strive for the invisible hand to always be on our side, but it only amplifies collective mistakes. The only hand we can rely on is our own, pressing the button in strict compliance with the rules. The true power of a trader lies not in intellect, but in their ability to maintain an ideal system of self-control, independent of market price dynamics. Survival in the market is not a function of knowing financial news. It is a function of managing your internal desire for psychological alignment. We must constantly cultivate the impartial spectator so that it is strong enough to ignore the noise of the crowd's sympathy. This spectator is the only guarantee that you won't sell at the bottom when everyone is panicking and won't buy at the top when everyone is boasting about their millions. The realization of the philosophy of ownership and validation is the first step toward freedom from market manipulation. Your position is a tool, not a part of yourself. Your money is ammunition that must be used with military precision, not emotional stakes that need to be defended. Only when you cease to need the market's sympathy will you begin to see its clear, unemotional structures. The next time you feel an intense urge to close a trade that just went into a small loss, ask your spectator, what is my motive? Is it the defense of capital according to the plan, or the defense of the ego from the feeling of being wrong? You will quickly see that 90% of these impulsive actions have zero moral quality. The cruelty of the market is its greatest blessing,
as it immediately punishes the slightest deviation from the process. To solidify this principle, I propose a mini task for your next trading day. Every time you open a trade, write down one sentence describing your objective signal and one describing your emotional state. After 24 hours, compare these entries. Was the moral quality of the motive as high as the expectation of profit? Write in the comments your key level in the current market and which scenario you see more often in the last month, a true strong breakout or a returning false exit, fake out. Allow the impartial spectator to begin its work. Adhere to the plan, control only what is within your power, and the market, as the invisible hand, will bring you liquidity itself.